All right, welcome to The Explainer. Today, we're going to break down the one idea that, and I'm serious, unlocks the entire world of finance. If you can get this one concept drawn from Tony Bell's amazing work, everything from stock prices to business deals is going to suddenly click. Okay, let's just dive right in. And you know what? Forget the spreadsheets, forget all the complicated jargon for a minute. We're going to start with a really simple human problem, something that finance is totally obsessed with solving. So I want you to really think about this for a second. Your most trusted friend comes up to you and says, "Hey, I will give you $1,000 guaranteed exactly 1 year from today." The question is, what would you pay them for that promise right now? Go ahead, pick a number. This isn't some kind of trick question. This is the question at the very heart of all of finance. And yeah, I know what you're probably thinking when you see this slide. Wow, that portrait of Grover Cleveland is photorealistic. They must have used some incredible AI for that. Nope. The source material actually jokes that this was drawn by hand, and honestly, we're just going to stick with that story. It kind of makes finance feel a little more approachable, right? So what number did you land on? Maybe something like $950? You know, your gut is probably telling you that the promise has to be worth less than the full 1,000. And guess what? Your gut is 100% right. Or, hey, maybe you were thinking closer to $900. I mean, it makes sense. You're giving your friend cash today, and you have to wait a whole year to get it back. There's got to be some kind of discount in there, right? For the wait and for the risk? Or maybe you're a little more cautious, and you landed on something like $800. See, the exact price you pick, it really just depends on how big of a discount you need to feel like you're getting a good deal. And that right there, that brings us to the most crucial point. Figuring out the right price for a promise of future money, that is the fundamental question of finance, period. Whether it's an IOU from your friend or a massive multi-billion-dollar company, the core problem is exactly the same. All right, so now let's see how this simple little question builds into the single most powerful idea in all of finance. Seriously, this is the concept you're going to hear again and again and again in any finance course. And here it is. It's called the present value of future cash flows. That's it. That is the secret key, the whole shebang. The value of any financial asset, a stock, a bond, an entire company, is just what all of its future cash flows are worth today. So why? Why is future money worth less today? Well, the logic is actually super simple, and it really boils down to two main things. First, you've got risk. Your friend is great, but hey, life happens. They might not be able to pay you back. And second, there's what's called opportunity cost. That money you give them, it could be sitting in a savings account, earning you interest all year long. You're giving up that earning power. You know, this focus on real money, it leads to this really fascinating, almost philosophical clash of the titans between two worlds, accounting and finance. And this slide just nails the core difference. The accountant looks at a business and asks, okay, what's our profit? But the finance pro, they look at the exact same business and ask a totally different question. Forget profit for a second. Where's the cash? And just like Tony Bell says, in accounting, so much is based on estimates and projections. They're all essentially guesses. Finance people look at that and they're like, yeah, but the realest thing you can have is money, cold, hard cash. It doesn't lie. Okay, so if profit isn't the real number we should be looking at, how in the world do we find the actual cash a business is generating? Well, you guessed it, finance has a special tool for exactly that. It's a little something called operating cash flow, or OCF for short. I want you to think of this as the financial heartbeat of a company. It's the cash that's coming in just from the company's day-to-day business, selling its stuff. And what's cool is that finding this number is actually pretty straightforward. This slide lays it out like a simple 3-step recipe. First, you start with a company's operating earnings. Then you add back any expenses that were on the books but didn't actually involve cash leaving the building. Depreciation is the classic example. And finally, you subtract the actual cash that was paid for taxes. And boom, there it is, the company's true cash flow. Okay, let's bring this all full circle now. Let's connect the dots and see why this one simple idea, valuing future cash, totally changes how you see the entire financial world. Look, this isn't just some clever theory you learn in a textbook. This single concept, valuing the present value of future cash flows, it is the engine that powers all of finance. Every decision, every valuation, it all comes back to this. I mean, this one idea is used to figure out the value of pretty much everything. The price of a company's stock? Yep, that's the present value of all its future cash flows. Government bonds? Same thing. Present value of future payments. Deciding whether to build a new factory? You bet. And yeah, even figuring out what to pay for your friend's $1,000 promise. It's all the exact same logic.
So here's the big takeaway. The next time you see a stock price flashing on your screen, I want you to remember what you're really looking at. It is not just some random number going up and down. It is the entire market. We're talking millions of investors making their collective best guess about every single dollar that company will ever make in its entire future, all distilled down into one single number for right now. And when you see it that way, well, that's a pretty powerful way to see the world.